Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. Now, most of our discussion on this program deals with investing in stocks. As I mentioned, Frank is the managing director of an alternative asset group. So, Frank, what are alternative assets and what is that area open to most investors?
Unfortunately, they're not open to most investors because alternative assets are not in marketplaces. They are illiquid assets by nature. As Kerry mentioned a few weeks ago, the liquid alternatives that grew out of the last few years trying to allow people to get exposure who can't afford illiquidity didn't do that well. I suspect the reason for that is because they're liquid. Liquid things are bought and sold, and I can remember when I started dreaming up these ideas about alternative asset funds, trying to bring the concept to the quote mass affluent. A young man said, "Frank, these things are available in the public markets. Why would you give up liquidity?" And for a short time, I was paying attention. And I told my son to pay attention to these illiquid things, and he said, "Dad, they went down more than the market." So happened shortly after that, the market sold off a bit, and these liquid alts went down twice as much. And I said, I should know better at my age. People, when they get nervous, they sell the thing they're least familiar with, the thing they understand the least. And that's going to be the alternative funds, whether it be a hedge fund or a private equity fund. And if it's liquid, they're going to cut and run because they're afraid and they don't understand what they own. Illiquidity reduces volatility. Assets like in real estate, private equity, even venture to some degree, although that's a little risky for my blood, and hedge funds to some degree are structured in such a way to take the emotional selling out of it. They're still tied to the economy. They're still going to be affected negatively right now by rising interest rates. You're seeing the private equity people revalue their assets lower than they were maybe 6 months or a year ago. And that's a function of where the economy is. But you don't have panic selling because you can't. You have to live to the end of it, which eliminates a lot of people. They cannot afford illiquidity. So for the person with a couple of $1 million or more, a fund like mine is set up for them, and because we will give them a diversified pool. Because just like in stocks and bonds, diversification is what makes this work, not one-off things where you go because it sounds like a good thing. Because if it turns out to be not a good thing, you're stuck to the duration, and it becomes risky where you can lose all your money instead of just having it go down for a while.
Kim, you're nodding your head.
I am. And actually, this is funny. This is one of the areas that is affected by interest rates. So anytime that you're going to use borrowed money to do something, that is build out your company, that's one. Companies don't seem to be doing that right now or for a long while. But if you are a company that goes around and buys other companies, that's private equity, that they're going to buy either all or part of a company, they love zero interest rate environments, right? Like it's risk-free. Not really, but you're not paying for that risk of borrowing the money. So this is an area that can benefit. And if you think interest rates are going to go back down, Frank, would you be piling into more of the private equity side than real estate, we'll say?
Unlike Jim Cramer, Kim, I don't back up the truck to anything. I don't pile into anything. All right. And I didn't say I think interest rates are going down. I just didn't think they were going to go up much.
Michael, your thoughts?
Already, sure. I don't see why they should go down.
So we've been there's the private side is so big and diverse that I don't think many investors probably know how big and diverse it really is. To Frank's point and Kim's point, private equity is one component of alternative investments. And we have some clients who invest in true private equity where their money is locked up for 10 years and you can't access it. And we have a whole host of other clients that are in what we call semi-private or semi-liquid, where your capital is tied up on a monthly or quarterly basis, where if you do need access to that capital, again, you can access it in most cases on a monthly or quarterly basis. We think there are certain areas of the alternative investments we like a lot right now, and some we don't like as much. We are a fan of private credit in this environment, particularly as the public banks are beginning to pull away from this type of lending, given some of their troubles. Private credit is generally floating rate loans. So as interest rates go up, they're able to reset their loans higher. And if you have a very broad set of companies that you lend to, a book of maybe more than 250, 300 companies, yes, even though we're heading into a more difficult environment, I think going forward from a profit and revenue standpoint, again, you can keep your default rates pretty low and still earn a nice return on that on your capital there.
All right, Carrie, what are your thoughts about your new best friend, Michael, here in this space?
Well, we don't use alternatives. To Frank's point, you know, when you take an asset class and I appreciate it, I understand it, I have some myself, but to Frank's point, it only works because of the illiquidity, right? You don't have the emotional buying and selling. So I think when it comes to the alternative space, it is very important to know exactly what you own. Funds of funds don't necessarily work for me. I want to know what's in there. I want to know how businesses operate. Let's not forget that Silicon Valley Bank failed because of venture capital, because venture capital companies needed money. Interest rates had gone up, so they had to draw their money out of the bank. So it is a very tricky space. But the main reason we don't use it is because we can't model it. My job is to take care of my clients' money. If I can't model it, what happens if interest rates go up? What happens if growth slows? What happens if energy prices rise? I need to be able to model that. And with a lot of, not so much sector specific, like real estate I like as an alternative asset class. I think it works really well. But when you get into some of these other hedge funds and managed futures and everything else, I can't model it. So I can't give my client the confidence that their cash flows are actually going to work and they're going to be able to meet their long-term plans.
All right, we have to take a break. We'll be back in just a moment.